Yeah, so when we started the meeting, I was telling them that the forex market is heavily manipulated, because when you are talking about the forex market, when you are trading forex market, you are going to trade against insiders, people who have more information than you do. You are going to trade against big banks, big, very big institutions, right? And these people are in charge of price movement. At any point in time, they can move the market direction to any point that they want. They don't care about you, right? Because whilst you are looking for money, they're also in the market to make money. They are not just in the market um, for the sake of being in the market. They're also in the market to make money. So what they do is that always, well, they keep on manipulating price, right? So today we are looking at liquidity. So liquidity is basically how the banks manipulate the market. So when we started, I was showing them some articles. Now this is an article from CNBC, where some of the top banks. They are talking about the top banks. You can talk about Barclays Bank, Citi, JP Morgan's, the Deutsche Bank. So a lot of them. So these banks were actually fined $1.2 billion for forex region. Right, I don't know if anybody understands region, but when they say region is basically when somebody is manipulating something. So these banks were fined, and this is a trusted site. This is the CNBC, right? You can also get some proofs from the Guardian, where they are proofs that these guys are fined for manipulating the forex currency and certain currencies. So in today's meeting, I'm going to show you how you can actually identify some of these manipulations. Now, when you are doing other blocks, you get more in depth into this. You get more in depth into liquidity when you are looking at other blocks. Hopefully, next week, God willing, you are going to start looking at other blocks. So this is it. Banks hit by a record fine for reaching the forex market. Do you think that is going to make them change their mind to never keep on raging the forex market? Please, I need a response. Somebody should just respond to this question. Do you think they are going to stop?
No, 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 no.
Definitely, they are not going to stop because of just a $1.2 billion fine, right? So this is something that keeps on occurring. Now I'm going to demonstrate this thing to you, how this thing actually happens and how you can see it for yourself. Right, so let's look at an example, the Euro Swiss franc market crash. So this is an example of how the banks manipulate the forex market. So I think that happened in January 2015. So let's see what happened. Now this is a very famous thing that the majority, if you have been trading for long, well, when this thing actually occurred, I was not trading at that time, but I've heard about it because this is a very famous thing, something that happened. So this was what happened. The Swiss franc, or the Swedish economy, they decided to peg the Swiss franc against the euro at 1.2. So what they said is that they are not going to make price fall below that price, the 1.2. So you see that for a very long time, like the price was never able to cross that 1.2, that 1.2 price, because that was what the Swiss franc economy decided. So because of that, because a lot of traders knew about this thing, because they knew the price was never going to cross below the 1.20. If you're a trader, what do you think you'll be doing? Are you going to be looking for buying opportunities on this very pair, or are you going to look for selling opportunities? Are you going to look for buying opportunities? Because
Selling.
no, because listen to me. They say that the price is not it's never going to. They peg it. When you say peg it, it means that they want to keep the price above that price. So they say that they want to keep the price above 1.20, right? So if you are a novice trader, or if for any individual trader, what you'll be thinking is that because price is never going to fall below the 1.20, people start looking for buying opportunities. A lot of people were buying all from this place. People were buying, right? And then this is the daily time frame. So even though this is very small, you are seeing this thing very small, but when we actually drop down to the minute time frame and then those time frames, you find out that during that period there were significant price movements, right? So because the majority of traders knew that there has been a peg, and then they made this information available to the public that price was never going to fall below the 1.20. So what happened is that some of these big institutions, they came together, right, and they decided to move the price. Now see this crash. This thing actually caused a lot of havoc to a lot of traders, not just traders, even some brokers. Some brokers were completely wiped out. So they were even out of job. They were out of business during this crash. You see that in just a single day, the price was moved about more than 2,000 pips. The price moved at almost 2,500 pips, right? Because the majority of people were buying. So in one single day, look at each one of these candles is a representation of one day, because this is a daily time frame. So for a very long time, this was what was happening. The price was just consolidating. So people were looking for buying opportunities, because they had the information that the currency has been pegged at 1.20, right? And because of this thing is actually called a spike, right? When something like this happens, even stop loss are not going to be respected. When you have the stop loss at this point, they're still not going to be respected. When you have the stop loss at any point, they're still not going to be respected. So that was how. Now you can do some research into it, what actually happened. So this is a major event that occurred in the forex market, and that occurred in 2015, January 2015. So please, I hope it is making sense to you how these people actually manipulate the market. So what you want to do is that you don't want to be like the famous kid, right? You don't want to be like the famous kid. Menyesho say those who went to, and when you went to primary school, you know that, or not even primary school, you know that always the famous people, they must be our uncle class cry. Then everybody will see that, oh, this guy is not here, right? So you don't want to be like the famous kid, like the notorious kid who everyone knows. You want to be like the child who is under the radar. That child under the radar, even if the person does not come to class, nobody is going to notice that, right? So I'm saying this because when you are looking at some things like support and resistance, that is what almost everyone is teaching. Now, if you go to open your YouTube right now and start trying to learn about forex market, you see that everyone is going to be talking about support and resistance. So what you have to understand is that these people or these financial institutions, they know where your stop loss are going to be, because the support and resistance that you are learning, the institutions, they know it. Even you as an individual that you don't have any information about the market, you know this support and resistance. How much more or more they control very large capitals. They control very large capitals, so they have more information than you do. So always, anytime they are coming into the market, they know where our stop losses are. They know everything. Please, do you have any questions at this point? Any questions at this point? Or am I going too fast? Hello? Please, am I going too fast? Do you have any questions? Hello? Please, do you have any questions?
No question.
Okay. But are you understanding the things I'm talking about? I hope you guys are understanding it. Hope you're understanding it. Yeah. So that's pretty much it. So let's look at some more proofs. Now this is IG client sentiment. So IG client sentiment is a broker. They are like a broker. It's a very big broker in the United States. So what they do is that always, I don't know, when we were doing the market sentiment, I talk about this, where I told you that market sentiment is when we are gauging the market based on where the majority of traders are. Right. So IG is a broker. What they do is that they collate the positions that their traders are holding currently. Right. They collate all those positions, and then what they will do is that they will make it available to the public. And see, I'm going to show you how these banks actually manipulate the market. Now, when you go to here, these are the positions that their traders are holding, and these are all the information. But I'm just going to pay attention to this. Let's pay attention to this particular one. Let's pay attention to this particular one. So you, after this class, you can just come over to IG client sentiment and look at some of this information. So now the blue one is what? Net long. I hope by now we all know what long means. When you say long means you are buying, or long means you are expecting higher prices. So when you see the blue lines, it actually means that what? The traders were long. When you see red, it means that the traders were short. Okay, I hope that makes sense. Does it make sense? Yes, so I hope it makes sense. So what happens is that, so anytime you see where the red line is, when you see the blue line, it means that what? The traders were bullish at that point in time. And when you see the red one, it means that the traders were bearish in time. So these are the positions that their traders are holding. Right? So this is a percentage of traders. The net long is those who are long, the net short is those who are short. So you see that always these things are not what? Always moving in the opposite direction. Right? These are some things that like a lot of people do not know. Most people do not know some of these things. Right? So you see that when the price was moving up here like this, when the traders were buying at this place, at this point they were long. See, they were long, they were buying at this point. What happened? The price was actually moving down. See, this is a price on its own. This is a price. See that the price is moving down, but this is what the majority of their traders were doing. Right? At this point, majority of their traders were net shorts, so they were selling and selling and selling. What happened? They will move the price in the opposite direction. So, of course, we call them the smart money. Of course, they are not stupid. Now we call this the blackjack principle. So sometimes, once in a while, at some point in time, they are going to make you win some. They will not always make you lose, because if you lose, you don't come back, right? So because they want you to keep on coming back. Because just think about this. Maybe if you go and learn about support and resistance, and then if you apply it, and then the trade actually works, it's going to make you feel good about yourself. You feel like very smart. What do I say? So occasionally, they'll make you win some of the trades. So what I say? They'll make you win some of the trades so that you feel better about yourself. Oh, at least this thing is working. In the long term, I'm going to be profitable. But the actual thing is that they know what they are doing. So please, let's have this in mind. So always, this is not the only pair we can look at. So anytime you see the traders short, you see that the actual price is moving up, right? This is the doing of the smart money. At some point, so this is a point where, like, the market was on point. But when you look at some of these things, some of these places, you see that anytime the majority of traders are net long, you see that the smart money will what? Take the opposite side of the traders. So there are a lot of them. You can come over to this place, to this site after this class, and then you look at some of them. Yeah. So that's pretty much it. So today we are just going to end with liquidity. Please understand liquidity, because we are going to mention liquidity a lot in our next classes. So how do you identify these areas of liquidity? Hello Alice, what do you think? Should we end the class and continue tomorrow? Is it late? Should we end and continue tomorrow? Okay, so so let me continue. There are a few people here, but so let me continue. I'm pretty sure you watch the recorded one. Yeah, so when you are talking about areas of liquidity, you are looking at trend lines, you are looking at Fibonacci, you are looking at the moving averages, because this one most people are taught. So from our beginners class, or from the beginning, I told you that I showed you how to use the trend lines, where I told you that there's a first touch here, there's a second touch here. So the next time or any time, so when you are talking about liquidity is basically where we have what stop orders, we have pending orders and stop losses at. So I told you that from the beginning of the training, I told you that there's a first touch at this point, there's a second touch at this point. So the next time price gets to this place, we start looking for our buying opportunities. Now when you are looking for the buying opportunities, this is where you're actually going to put your stop loss. You put your stop loss below a certain low, because once price come over to this place, what you are now thinking is that now what the price is switching to a bearish, because those who are buying at this place are no more, so they should be what selling and selling opportunities. So when you are buying at this place, you are going to put your stop loss at this place, right? Same way for those people who are also looking for the breakouts, or the breakout traders too. They are going to have their pending orders here. They're going to have their pending orders here, which is what sell stops and orders and orders, right? So what the institutions will do is that, because they know that stop loss are at this place, when they don't have enough money to move the market in their desired direction, they will reverse the price to where these stop orders are. See, so for those who were buying at this point, that they had their stop loss at this place, they will be wiped out anytime the price actually gets over to this place. So now it means that they are out, they are not in the market anymore, right? For the breakout traders too, once the price gets to this place, it means that their pending orders are going to be triggered, which means that now they are also going to be in a trade. So sometimes what they will do is that they will activate the pending orders here, and then they will move the market like against them. So for those who are buying at this point, it means that their stop loss have been taken, and then they are out of the market. Same way for those who are also selling at this place, also their trade has been triggered, and now they also been taken out, because they are also going to put their stop losses around this place. So when you are talking about liquidity is any point that you can think about when you think, oh, traders are going to put their stop losses here, traders are going to put their pending orders here, right? So this is what the institutions do. Usually they just target these price levels or these price points. This, you can call them liquidity pools, you can call them buy side liquidity, sell side liquidity, anyhow that you want to call it, you can call it, but the general name is liquidity. Now it's not only trend lines that we have liquidity at. You can also look at double tops and double bottoms. So you have a touch here, you have a second touch here. Anytime price come over to this place, you start looking for selling opportunities, right? But what will happen is that usually small money will just come and grab the liquidity, because when you are entering at this place, your stop loss is going to be at this place. So I'll demonstrate it to you how some of these things actually happen. So it's not only trend lines, you can also look at session highs and lows. Now these session highs and lows, when you are looking at our Asia session liquidity sweep or the daily pip cycle, I'm going to explain this thing very well to you. liquidity resting above the highs and lows of sessions. Remember, we have different sessions. We have the London session, we have the New York session, and we have the Asia session. Right. So that's it. So that's it pretty much for the liquidity. We will talk about liquidity more. Now the new thing is inducement. When we get in the future, we'll talk about inducement. But for now, we are just looking at the basics of liquidity. We are just looking at the basics of liquidity. So let's say if you have a double top here, you have the first touch, second touch here. Now the next time you are going to place a trade, you put your entry at this point, you put your stop loss at this point. So it means that there is money at this place because they are at stop loss at this place. If they tap you out, it means that now they've taken your money and you are out of the trade, right? So they've taken your money. Same way for the trend lines to first or second touch, you put your entry at this point, you put your stop loss around this place, right? Same, you also have pending orders at this point. So any place that you can think of where you can think they are stop losses or pending orders are. That is the area of liquidity that we are talking about. So this place to the same thing. You have entry point here, stop loss here. This place is a perfect liquidity. So let's look at some price examples. Let's look at some examples on the price chart. Hello? I hope you guys are following. Hello, Kojo? Yeah, so let's move on. We have looked at support and resistance. I told you that there's a first touch here, there's a second touch here, there's a third touch here. So anytime price gets here, what do? You start looking for selling opportunities. Now, when the price actually go to this point, see, when the price touch it, the price moved down a little bit. So if you had placed a sell order at this point, I'm pretty sure you'll be happy. Oh, I'm in profit. You're already in profit, so you're happy. But see what happens. Small money reverses the price to the area of liquidity, because this place, or there are liquidities resting above this place, because pending orders are at this place. For the person who was selling at this place, they have what? Their stop loss may be above this low or this low, right? So they will just come and grab the liquidity. So when something like this happens, because you saw it working at this point, because right at the touch you'll be getting a sniper entry, right? So you feel good. So that's the reason why I said they'll try as much as possible to make you feel better or feel good about the trades that you are picking. But in the actual sense, something is actually what's happening, or something is going on that you are not aware of. So that's how they manipulate the price. So price them moves in their direction to motivate them to continue using the strategy. So what they are trying to do, they are trying to make you think that the strategy is actually working, but in the actual sense, it is not. Now, I'm not trying to say that. I know some people, some great guys, some Forex gurus who use support and resistance and trend lines. I'm not trying to say that they don't work completely. Any strategy actually works when you combine good risk management with any strategy. It can be profitable. I know some guys who just use moving average and they are still profitable. Okay, so that's it. Let's look at some more examples. When you are looking at this one too, you have a first touch here, you have a second touch here, you have a third touch here, right? So some people actually sold at this point. The next time price gets to this place, what have I been telling you in the past? That first and second and third touch, so you can start looking for what? Entries at this point. When you are looking for entries at this point, you are going to put your stop loss above these places. So these places are what we call what? The areas of liquidity. Because you are going to have your orders at this point. And then see what happens. This is actually the same thing. What they did is that now what? They will come, they will move the price to the area of liquidity. They will move the price to the area of liquidity. So for those people who were looking for the breakout, or for the breakout traders, they have our pending orders at this point. They have their buy stops at this point. So you see that now their buy stops are going to be triggered. So the buy stops will be triggered. So it means that now they are in the trade. for those who are also looking for selling opportunities, their stop loss have been taken at this point because their stop loss are above these places. So their stop loss has been taken. For those who are also looking for the breakout, they are also going to be stop out because their stop loss are probably going to be around this place. Because for breakout, they expect the price to keep on moving up. Right. So if you are buying, you're a waste man. If you are selling, you are still a waste man. So that's pretty much it how these guys manipulate the market. So please, I want you to be aware of liquidity in the areas where liquidity rests. Yeah, so I can give you like dozens of examples, like different examples. So first touch, second touch, third touch. So because of that, people are looking for entries at this point. Their stop loss are going to be at this point, right? So their stop loss are going to be at this point. So what they will do is that they will move the price to what? The area of liquidity. So now if you were buying, if you were selling, you had a stop loss at this point. Things that now you have been wiped out. And even for those who are going to be in the long positions, for some of them, because of fear, do not allow the price to get to their targets. They will close the trades because they don't want to lose some of the profit that they've made. Yeah, so that's it. So that's how the big banks, that's how they also make their money. That's how so always just understand that these banks, they trade against us. This is actually true. It's actually true, right? They always trade against us. You see, that's it. This is actually called inducement. So this one, I don't want to confuse you. So for now, I'm just going to leave this out for now. When you do other blocks, I'll teach you what inducement is. Yeah. So it was wonderful having you here. I hope to see you guys tomorrow. Tomorrow, God willing. Please make sure you watch the video if you are not able to join the class today, or if you're having some network challenges. Yeah. So I'll see you guys tomorrow. Tomorrow, God willing, we look at imbalance, and then we also look at the two fundamental rules. These are going to be very short class, especially if you understand liquidity. This is going to be a very short class. So please, let's try our best. Yeah. Have a wonderful day.